Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
All right. So welcome, Value Builder community. Today I'm talking with Adam Dunn, Managing Director of Berkadia in Boston and a host of CRE Deal Room Podcast. Adam has been in multifamily brokerage for 12 years, but what's interesting, he built a podcast alongside with his brokerage business. We're going to get tactical, how he started, how he evolved starting 12 years ago. And we'll dive in also how podcast helps his business tremendously. So I'm super excited to have this conversation with Adam. By the end of this podcast, you will see how massive growth feels in multifamily when it comes to brokerage and how the podcast can help you with a business. So welcome to the show, Adam. And if you can give us your brief introduction so my audience can know what you're doing and where you're from, that would be great.
Great. Well, thanks so much for having me, Saul. I really appreciate the opportunity to chat with you and your audience today and share a little bit about my story of jumping into the brokerage business and share a little bit about what happened when I got into the business and where I am today. Happy to answer any of your questions along the way, but maybe just kick things off. I'm Adam Dunn. I'm a managing director at Berkadia here in Boston. My team covers New England. We primarily help owners and investors of multi-housing assets buy, sell, and build apartment buildings across the Northeast. We also sell development sites, and we help developers capitalize their development properties via raising JV equity and construction financing.
That makes sense. Now let's go back right now into the humble beginnings. I think you started way back when in leasing apartments. So walk us through that decision, starting from property management, leasing, and building that massive brokerage business. Can you give us a flavor? How does it look?
Yeah, absolutely. Thanks for asking. So I've been in the commercial real estate sector for about 20 years. When I first got into the business, I started in the property management side of the house, which is what you referenced. Kind of interesting. I always grew up wanting to be in the real estate business. My parents were residential real estate agents, and they owned a brokerage company where I grew up in Tennessee. And I thought my path in middle school and high school, obviously, was going to follow their footsteps, right? I was going to get into the residential real estate business. I was going to sell homes. And then I went to college, and I ended up taking a commercial real estate investments course in college, which changed my perspective in the real estate world. And I realized that I wanted to go into the commercial real estate path as opposed to the residential real estate path. When I graduated college in 2008, I had applied for a commercial real estate brokerage position, and the gentleman that I spoke with said, "Don't do it unless you have 2 years worth of savings." I did not have 2 years worth of savings. I had like $2,000 to my name from working in college. So I ended up accepting a job as a manager in training at a apartment management owner-operator in the Southeast. They had about 14,000 apartments at the time. And, I read manager in training. I was in college and thought that, this management path could be interesting. Little did I know that I was going to be on site in an apartment community as a leasing consultant. It was my job and learning the day-to-day of the property management industry. But in 5 days after graduating college, I walked on site to a 356 unit Class B apartment building in Charlotte, North Carolina as a leasing consultant, and really learned all about apartments from the ground up, starting in leasing. And I was fortunate that, 6 months later, I was offered an opportunity to be the property manager of a building, a 100-unit apartment building in Virginia. So I relocated from Charlotte to Virginia to take over a 100-unit apartment building in October of 2008. Believe it or not, I was the eighth property manager during 2008 in 10 months. And so when I took over the property, it was, 20% vacant. There was a significant collections issue, and it really needed someone to help turn around the property. And out of the 45 properties that the company owned, that was the laggard in the portfolio. It was number 44, 45 in performance for 2008. And, fortunately, 12 months later, we were able to right the ship, so to speak. And we ended up being, 100% occupied with a 2% delinquency rate and, fully renovated 100 units over the following 12 months. The property in 2009 was number one in property performance, year-over-year NOI growth, which I was very proud of, and that set the stage for me to go help reposition apartment buildings at the company that I was working at prior to getting into brokerage. I spent 4 years on the management side in order to save 2 years of savings to get into the brokerage business. And in 2012, I made the leap. And, coming from the apartment management business, I went from managing, the smallest building was 100 units, Class C, to go manage a Class A high-rise, 456 units in 2012. So got to see Class A, B, C apartment operations, which was super valuable to get into the brokerage business. And when I got into the brokerage business in 2012, I was thinking, because I was managing these 50, 100 million, $200 million apartment buildings, I was thinking I was just going to go sell those 50 million, $100 million, $200 million apartment buildings. Well, that was a big reality check, because when I got into brokerage, I was selling $1 to $10 million apartment buildings. At least that's what I was calling on to sell. But you talked in the beginning of the podcast in your introduction of what does my career in brokerage look like over the last 12 years. Over 13 years, my first apartment building that I sold in 2012 was a 6-unit multi-house building in Washington, D.C. for $350,000 total. And that was where I cut my teeth on the private capital apartment buildings in Washington, D.C. My team this year, our average deal size is $105 million. So over the last 12 or 13 years, we've been able to build out an incredible business that really started in the private capital and middle market space, and we've been able to develop relationships over the last 10 to 12 years to get to a point where these largest institutions in the country, if not the world, trust us to help them buy and sell and capitalize apartment buildings.
That's amazing. So give us the time frame. So 300 and change thousand buildings are right now $100 million plus. How many years took that?
So between starting in the brokerage business in 2012, I ended up relocating from DC to Boston in 2016. And when I started in the brokerage business, like I mentioned, my first deal was $350,000. In the 18 months that I was at that firm, that was mostly building relationships with private capital middle market buildings. I had the good fortune to go work at an institutional brokerage business that was doing, $2 billion a year in investment sales in the DC market. And, I went from selling $350,000 to, $5 million apartment buildings to joining a team as being the youngest person on a 8 to 10 person team. And we were selling $2 billion worth of real estate a year. Taking a step back, in 2016, I started from zero for the second time. The first time was in 2012 when I built my book of business in DC, relocated for family purposes to Boston in 2016, and had to start all over again. So when I relocated to Boston, no one knew who I was, no one knew who my team was, and it was really taking that granular, detailed approach of building out a database of who are the owners in the market, and picking up the phone and introducing ourselves and meeting everyone. And from 2016, we had zero market share. We were doing zero business. And over the next 5 years, we built out a brokerage business to compete with the top brokerage companies in the market. And before we left to go to Berkadia in 2021, I think we did $700-800 million worth of real estate investment sales in the greater Boston market of mostly Class A institutional apartment buildings. So while I've been in the business for the last 12 or 13 years, really starting from zero again here in Boston in 2016, call it 4 or 5 years to build a brand, build trust, build relationships, to get to a point that these institutional investors feel confident that you can help them monetize their real estate.
That's amazing. Yeah. And I want to do couple follow-up questions, but I want to have a comment that you definitely clearly coming with a ground zero experience of leasing and optimizing those buildings. And the way I see in commercial areas, they pretty much worth nothing, obviously, if there is no one is paying for the rent. And my son, he's 18. He, asked me, what's the best way to learn commercial real estate? You know what? I know many folks trying to skip and go right away, go investment sales. But in order to really, really understand it, like from a ground level, you need to understand leasing and all the intricacies. What is OpEx? What's the magic consist of optimizing operating expenses? What's the magic consist of optimizing leasing? If you understand it, you're going to be so much better than anyone else. And if you don't start
Absolutely.
there, you skip right away to investment sales. I could see who was that person who went through that thing. And then, so I definitely see that. With that, with your right now institutional sales, do you still offer your services, whether property management or optimizing some consulting and OpEx, or you are mostly in investment sales right now? What's your business compared right now compared to 12 years ago?
Yeah, so starting 12 years ago, I've got completely out of the property management business, but that management processes and understanding has been critical in my brokerage business, understanding how to tear apart a T12 and
Mm-hmm.
profit and loss statement, and kind of understand really how to articulate a subject properties, characteristics compared to the market, and be able to really craft a story or a narrative to allow folks to understand an apartment building that you have intimate knowledge on from just from learning the
Mm-hmm.
property management business so long ago. And those principles still apply today, although management has certainly evolved. Brokerage has evolved over that time period. But the basics in the blocking and tackling and the foundation
Mm-hmm.
that was built over 12 years ago still applies today. So it's been critical to be able to understand the inner workings of an apartment community.
So, so on investment sales right now, do you offer property management service to your clients or no, or that's not really the focus anymore?
Yeah, no, it's all investment advisory, and JV equity placement, construction financing. It's all capital markets focused, if you will.
Yeah, but at the same time, I'm pretty sure it's for you. It's still a second nature, and looking at it in the docks, you don't have to go for 2 days diving in. You can spot exactly the levers you need to move because you've done that. I definitely can
Absolutely.
relate because I've done a lot of leasing and I still do some leasing on my portfolio, but I can see such a big competitive advantage, when it comes into getting to the clarity what needs to be done to make this property more profitable, just because I've done it so many times on the other end. So
Absolutely.
great for sure. Now, what I want to follow up is your journey for hundreds of thousands to hundreds of millions. Would you be able to distinguish or identify the steps that you had to reinvent yourself? Who is your avatar in terms of client? I understand there was a private investors and there is probably institutional investors, but maybe there are some steps in between, like, working just with local mom and pop, and maybe there's a syndicator, maybe there is a couple of and that's how you have to adapt and evolve yourself and probably recreate your team. Do you have those steps? Maybe you never were asked that question, but maybe you can walk us through, because that's really the expansion of your deal volume per transaction is extraordinary.
Yeah, no, great question. Today my avatar is mostly institutional equity investors and national developers, and
Mm-hmm.
that's generally who we're building relationships with today. When I was starting the brokerage business, it was who are the top 2,000, 3,000 owners in your market, and try to go meet every single one of them. Today, my business has evolved to a point where I'm building and maintaining relationships with institutional investors, and there's a finite universe of those groups. Instead of 2,000 to 3,000, there's probably 200 to 300 that are really active in the markets that I cover. And so it's, and exceptionally important, particularly given how competitive the brokerage business is. In Greater Boston, I've said this to others, but the competition are all great people, right? And they can all transact real estate effectively. So you're always asking, how can you distinguish yourself in the market? And for me, it's been a data-driven approach. So what you see online from me is mostly market intelligence, and that market intelligence appeals to all investors, whether they're private capital, middle market, or institutional. But I do feel strongly that the institutional investors rely more on a data-driven approach to make their investment decisions, because they're generally reporting to an investment committee and they need to present facts and data to the investment committee before they make a decision. Whereas, if you're talking to a private capital or middle market owner, they may be reporting to themselves, right? And they don't have an investment committee that, it's their family that they're working on behalf of, and they're the sole decision maker and can make more emotional decisions. Institutional investment space is very much more calculated and disciplined investment that they're underwriting. And so relying on advisors like myself who take a data-driven approach to help them make informed decisions is what I try to implement across my mediums of communication.
Makes sense. Tactical questions. On the deals of that size, your typical institution, actually maybe for your business and for your avatar, is that typically more stabilized, very long-term investments, or that's still value-add development, heavy lifts? Where that falls in the spectrum when you're $100 million transactions? Every week, I read hundreds of commercial real estate articles from across the U.S. and around the world. I connect the signals, break down the Fed moves, and share real case studies, not theory, from my 2 decades of real estate experience and actively doing deals right now. My team and I spend 15 plus hours on a weekly basis and deliver this to you for free. You can read it in 5 minutes. So every Sunday at 9:07 a.m., you'll get major commercial real estate news that matters, one Fed insights that matters, one deep dive case study from me or one of our operators who already made the mistakes, so you don't have to. Thousands of commercial real estate operators and investors read this newsletter, especially in the value add space. And don't take my word for it. Check out hundreds of reader testimonials online. Plus, when you subscribe, you get instant access to a Perform underwriting tool, the same one we use every single day to underwrite value add deals. Now, this is not for you if you're looking to get rich quick schemes, or if you're looking for theory and hallucinations, not real numbers, or you're not serious about commercial real estate. But if you want real tactics, real deals, real results, no bait and switch, go to joinvaluebuilder.com and subscribe for free. And see you there, guys.
Sure. There's very few value-add apartment buildings that trade in the greater Boston market, many of which are owned by just long-term generational families. There are some active market participants who are buying and selling value-add opportunities, but the majority of the trades that occur in our market, which is about $4 to $4.5 billion of annual transaction velocity, over $25 million, most of that transaction volume is newer quality construction, what I'll call core plus investment opportunities. So most of the deals that we're transacting on are either merchant developer deals that have been built, stabilized, and ready to sell, just as according to the business plan, but it kind of falls across the spectrum, across, value add, core plus, and core, but there tends to be more core and core plus that transact in our market.
That makes sense. Yeah, that kind of makes sense. Would you educate us a little bit on a capital stack? I think our deal size, 10 to 20 million, 5 to 20, probably most, and very little experience with institutional capital. Maybe when refi, it's with life insurance companies. But on the transaction this size, the debt, is that still Fannie Mae, Freddie, or is that typically different type of debt? And what are typical ratios between equity and debt on these type of transactions?
Great question. Our company is a prolific agency lender in the market across the country. So there was a significant amount of agency debt that was available this year. Both agencies hit their caps, as I understand it. And for 2026, both released statements a couple weeks ago that they're raising their caps to $88 million each. So there'll be a significantly more, I think 15% more total capital available, debt available for the agencies next per, 88 billion for Fannie, 88 billion for Freddie, as they're thinking about 2026. So there's going to be a significant amount of debt available from the agencies next year. The agencies in the greater Boston market in New England it's a very competitive market here on the debt side. We've got a very strong local regional bank market. So, deals of $20 to $40 million in total lending and debt is a great deal size for them. Once it gets over $40 million in total capital for debt, it could go to a debt fund, life co, or some of the other lending sources that might be available. Fannie and Freddie, given the volatility that we've seen over the last couple of years and some of the local regional banks being on the sidelines, have been more competitive in our market as of late. But generally, it's a very heavily banked market in the New England area. I'll talk to you a little bit about where we see loan to value, loan to cost in our market on the stabilized apartment front. We're generally seeing lower leverage across Greater Boston. We're not one of the markets that like the Sun Belt that's getting 80% LTV. That's just
Mhm.
not the nature of the market here. So we typically see 60, 65, 70% LTV is generally where most deals are sizing to today. Maybe I'll talk to you a little bit about the JV equity market and the construction lending market, as we're coming off of a opportunity that we were in the market with as of late, but call it $150 million total deal size, $160 million total deal size for a JV equity development and construction loan opportunity that we've been working on recently. How that capital stack will be comprised is, I call it $100 million construction loan and $60 million equity check.
Okay.
We're generally seeing the construction market today sizing somewhere between 60 to 65% LTC, loan to cost. And the equity is going to be 35 to 40% of that. And that's a pretty conservative capital stack lined up there for you.
Do you mind sharing range of disposition caps lately in Boston market? Let's say this size of deal, 100 million, core plus, class A. What are those caps? So we're in industrial world. We're probably 300 basis points higher, but I'm just want to get a flavor. If you may, if you cannot, I'll give you the pass not to share.
Yeah. Yeah, all good. So there's been like 22 deals over 25 million that have closed to date as we're recording this conversation. Call it close to $2.5 to $3 billion worth of total deals that have transacted by this recording date, and most of those deals have been in that core plus profile, and most have been traded in that 4.5% to 5% cap rate range. The best of the best real estate, core class A, great access to employment nodes, transportation, and amenities are trading closer to a 4.5, whereas the more kind of commodity oriented projects or that may be less desirable locations are trading closer to a 5. And some deals maybe just slightly north of a 5, some deals just slightly south of 4.5, but generally the 4.5 to 5 cap rate range is where we're seeing exit caps today. And then from composition of investor in the market today, it's across the spectrum. Value add, core plus, and core. There's a lot of liquidity pursuing deals in the market today. Many have told us that they don't already have a flag or asset that they own in Boston; they want one. So every opportunity that's in the market is generally seeing 100 to 150 confidentiality agreements that are signed, 20 to 30 tours. Could be 10 to 20 offers, but really just depends at a very basic level. And it goes back to fundamentals and property management. The best of the best real estate is outperforming today. And then it just kind of falls off from there.
Wow. This 5 caps, sub 5 caps. Would you do a 2 minutes crash course, for value add operators? To this day, I never dived in performance on the West Coast and East Coast, and I hear this, right? Sub 5 caps when the debt levels are 5 or more, 5.5. So even if you put a massive amount of equity, how those deals pencil out? If you can't really, you're still below the cap rate on what you have to service it at. How those deals actually work? I understand they work, but what's how they make it work?
Sure. Yeah. So a lot of it is rent growth driven, right? Particularly on the value add deals. The investors' investment thesis is that rents are going to increase through their value add program, and Boston's been such a supply constrained market that we're underhoused significantly to the tune of 4,000 to 6,000 units annually. We're underhoused. If you look across the entire state of Massachusetts, we're underhoused by, I'm told, 4,000, both for rent and for sale units. So we're a high barrier to entry market, significantly underhoused. And because of that, we're seeing outsized rent growth historically. And that is not expected to change anytime soon. The market will deliver around 8,000 units this year for new construction on the multifamily housing front. And then next year, it generally drops to 5,000 or 6,000, and then is even worse after that. And that's just a function of, it's been challenging to put a shovel in the ground over the last 24 to 36 months due to the capital markets front. It's been super dysfunctional. We're starting to see kind of tailwinds there, and deals are starting to pencil again. There's equity back in the market, appetite from construction lenders to see more starts. But because of that, we continue to be underhoused. And that's why you're seeing investors underwrite sub-5 cap rate deals in the value add space, that they're still putting on debt because they're anticipating that through rent growth and through improving value, that they'll be positive. On the flip side, whether it's core and core plus, we do see a number of investors that are either acquiring all cash or very low leverage. So because of that, on the lower leverage front, they're just getting better debt terms. If they're 45 to 55% LTV, they're seeing better interest rates than those who are at 70, right? So that's how we're generally seeing the market today.
Makes sense. So for underwriters that save, Fannie Mae or Freddie Mac loan, you have to be in line what they see in the rent growth. What do you see lately? It's being approved and being kind of forecasted in terms of rent growth. For example, in Boston, the core plus is that 3%, 5% rent growth over the next 3 to 5 years. What do you see is reasonable right now in the underwriting community?
Yeah, so Greater Boston is typically a seasonal market where we see a slowdown headed into the fall, and it picks up meaningfully in the spring. We're in the middle of that fall slowdown currently, where rents are, if they're not 1, 2, 3% rent growth, it could be flat. In some cases, it could be negative if it's a certain pocket, but that's just due to seasonality that we see in the fall. And if you look back historically over the last 15 to 20 years, the average rent growth, annual rent growth in our market is somewhere around 4%, across all product and all geographies of Greater Boston. If you talk to buyers and how are they underwriting deals that they purchase, if it's core plus, they're generally telling us that they're underwriting 2.5 to 3.5% rent growth, and I don't really see that changing unless there's a really strong story or a narrative around a property that's positioned to potentially outperform the market for various reasons, whether that can be operating fundamentals in the micro location or some secret sauce that the investor may have. Most are just defaulting to plus or minus 3% rent growth.
That's awesome. All right. And I know we're almost up in an hour. I want to get your perspective, if you may. What do you see in the next 3 to 5 years? Were you more bullish or more bearish? And I don't know if you can give a little bit of your flavor. How do you see a multifamily where you're at right now in the next 3 to 5 years?
Sure. Maybe I'll start at the local Greater Boston market. So we're typically a $4 to $4.5 billion annual transaction market for institutional real estate. This year, we're going to be closer to $5 billion, and that's just a function of a couple portfolios that have and will close before the end of the year. So we'll have an outsized year in 2025. I expect more of the same going forward in 26 and 27. We have a number of projects that have delivered in the last 12 to 24 months that will be stabilized. Will likely be sold. So I expect we'll continue to see the $4 to $5 billion in total transaction volume going forward. I do believe as long as we continue to see some stability in the interest rates, that we'll continue to see more shovels get put in the ground for new construction starts, which will be super beneficial to the Greater Boston market in general. Like I mentioned a moment ago, we're just so significantly underhoused that it's challenging for most people to afford either for sale or for rent housing because we're undersupplied. And just Econ 101, the fewer housing units available, rents go up, home prices go up, and that's not going to end until we see some stability in supply. And the only way we get to some stability in supply is if we have more shovels put in the ground. So I do see that occurring in our market. And so hopefully we continue to see positive tailwinds as it relates to stability in the lending market, so we can create more housing, which we so desperately need, because the Greater Boston market is super vibrant. We've got some of the best healthcare in the world, some of the best educational institutions in the world, all here in our backyard. So very strong and sticky demand drivers, which is part of the reason why I mentioned a moment ago that most institutional investors want to be in our market because of the durability of income. We're not a market that sees significant swings up or down as it relates to rent growth. It's a pretty steady performer over historical times. And because of that stability, it's considered to be a place that that institutional investors, they want to be just less risky of a perception here to invest in our market. And so, I'm long Greater Boston. I expect that we'll continue to see growth in our region, and despite some regulatory noise that we've heard as of late, I've got cautious optimism in the Greater Boston market going forward, as well as the broader U.S. multi-housing market. There have been markets across the country and cities across the country that have been oversupplied over the last several years. Think Austin, Nashville, Denver, Atlanta. Then I think we're starting to see some stability in some of those markets. But it's housing that was desperately needed across the country that is just kind of a result of population flows, demographic flows post-COVID. And while many of those markets were oversupplied, we're starting to see some stability as the construction pipeline was turned off over the last couple of years. So once we see the stability there, I expect those markets like that were oversupplied will start to see some rent growth and see some bellwethers in those specific markets that will really lift up the rest of the country as it relates to multi-housing investment.
Yeah, so clearly you're more optimistic and more bullish on the Boston, right? Yeah.
Yeah, I'm bullish across the country. Housing is a basic need, right? And we have a population that it's not just here in Greater Boston, but it's across the country that affordability is a key issue. So the more housing units, big believer that the more housing units that we have built across the country is going to be beneficial for everyone across all demographics.
Yeah, I write a newsletter, Value Builder, and I read probably 100 articles a week, and definitely in the last, I would say 2-3 weeks, yeah, definitely pendulum is the other direction that it seems like we hit the inflection point and transactions showing up. So I'm on the same aisle. I think it's going to be up and up from here, up and up. And it was a little tougher in the last, I would say 18 months. And yeah, Boston is a great city. I had time to spend last year. We were visiting colleges with my oldest son, and he was visiting Babson College, which is nearby, and we spent some time in downtown. I was very pleasantly surprised. It was such a vibrant, cool city. It's not as big as New York, smaller than Chicago, but such a great cuisine, great people. Just like, wow, it's unbelievable. Very nice, very, very nice city. So for sure, you can see a lot of good things happening there. Well, Adam, that was really, really amazing. I learned a lot. I know many of our listeners are going to learn a lot. Last thing, where they can find you if they have a deal for you to share, or if they have to reach out to you regarding multifamily, or whatever they need, they can bring any value to you. What's the easiest place to find you?
Yeah, no, appreciate you asking. I'm very public on LinkedIn, for example. So you can find me, Adam Dunn at Berkadia is where you find me on LinkedIn. You can email me at adam.dunn, DUNN, at berkadia.com if you want to get in touch. But I really appreciate the opportunity to share my story today with you.
Thank you so much, Adam. Really appreciate it. Awesome.
Yeah, you bet. Thank you.
You've been listening to the Value Builder Podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.